Broken period forward rate. Forward rate is expressed as a standard rate such as rates on April 30th, May 31st, so on. If the transaction falls on that date, fixing the forward rate is readily available. Now, what about a transaction that falls on a date before standardized rate? Let's see this in an example. We have spot rates on April 1st as 72, and we have 2 months forward rate on May 31st as 73. This is related to US dollars. Now, a customer transaction settlement falls on May 10th. So for May 10th, we don't have a forward rate. So here we need to calculate the forward rate via broken period forward rate method. Now in next slide, we will look how this is calculated. Now let's look BP broken period forward rate method and with an example. So let's first look at the equation. Broken period forward rate equals spot rate plus broken period pips. So we already know the spot rate here, and we need to find the broken period pips. For this, we need to see the equation for the broken period pips. So broken period pips equals the total pips divided by full period in multiplied by broken period. So what is the total pips here? The total pips is easy to find. You just have to reduce the spot rate from the forward rate given. So here 73 is already given, and deduct 72 from that, you get 1 rupees. That is the total pips here. So what is the total? What is the full? And the next is the full period. Period here means a total period here means from spot to the finish of the forward contract. That will be May 31st. So from April 1st to May 31st. So we have in April 30 days, and in May we have 31 days. So total 30 plus 31, 61 days. That is our full period. And next is what is broken period. Broken period means April 1st to then when the customer settlement happens, that is on May 10th. So in April we have 30 days, and in May we have 10 days. So total of 30 plus 10, 40 days. That is the broken period. So apply these values, just equate this value, replace these values in the equation, and we get 1, that is the total pips, into not multiplied by 61 divided by 40, multiplied by 40 divided by 60, multiplied by 40 divided by 60. That is when then we get 0.6557 something. So for the ease of calculation, we can round it up to 0.66. So here broken period forward rate equal spot rate, that is 72 plus 0.66, that is our broken period pips, equal to, we will get 72.66, 66. That is our settlement price on the May 10th. Banks will add add a margin towards this one. For the sake of understanding, let's believe that this is the settlement amount, and this is how we find out when a margin is given. Just add that margin to the this price. This code we got here. So here what we did, we did the calculation based on the forward rate is at the premium, that is it appreciates in future. Sometimes the forward rate also depreciates. In those times you have to deduct the what you get as the forward rate broken period pips. You have to deduct it from the spot rate to get the forward rate. That is broken period forward rate. Merchant rates. Let's start with an interesting question, like who fixes the exchange rates? In reality, the rate is fixed by the market itself through the play of demand and supply. There were doubts that if the price is controlled by Reserve Bank of India or some body or something like that, but it's nothing like that. But RBI does something. This is called they control the volatility. So RBI doesn't control the price, but they control the movement of price through their intervention, their intervention in the market. So to understand foreign exchange, you try to view it as a commodity than simply as currency. So if you view it as a commodity, then you will be able to understand the transaction much more easily, and you will be able to solve the problems you see more easily if you try to see any foreign exchange transaction as a transaction between two commodities, something like that. And now let's look into different segments of foreign exchange market. There are we can divide the foreign exchange market into three segments, like merchant market and interbank market and international market. If you are looking into merchant market, it's a here is a foreign exchange transaction between an authorized dealer and a public. This transaction is called merchant transaction, and it happens in merchant market. Thus, in this transaction, the rate offered by the authorized dealer to the public is known as merchant rates. Put it simply, it is the transaction between a regular customer and bank, and whatever the rates offered by bank is known as merchant rates. You can equate this market as a retail market, and the transaction values are relatively small. And now coming to interbank market, here the transactions are between authorized dealers. You can, or to understand in a simple way, you can say it's between domestic banks for easier understanding. Here the transactions are relatively big, and try to see it as a wholesale market of foreign currency. And the last one is international market. Here the transactions are between international banks. There must be maybe one domestic bank involved, but the other party, the counterparty will be an international bank. Exchange rate forecast. Exchange rate forecasting. There are four techniques that are currently known: technical forecasting and fundamental forecasting, market-based forecasting, and mixed forecasting. So technical forecasting uses historical data, then they apply a layer of analysis model, then a prediction they arrive. The stock analysis is somewhat example for this one. Um, Technical analysis stock market, and this might be useful for speculator, but for big corporation it might not be useful at all, since it has very short span, and it only try to depict a range or some certain price points. That's it. Not in long run it cannot predict anything. Fundamental forecasting uses economic variable to define exchange rate, but this also has its downside, with not there are certain things that cannot be quantified, and sometimes certain economic variable have a false understanding, false their impact may be understood in a different way than how it actually does. And in market based forecasting, in it uses the rates that is already available in the market, like they take spot and forward rates, and try to come up with the they build their price models on based on these prices. And the last one, mixed forecasting, uses is a hybrid of all these things, and they finally add a layer of weighted average to come up with the final